there is a risk of conflict that can be bad. We had a bad year. The worst case scenario, there are 5 kinds of wars. It's a big issue, and it will be a big issue for the rest of our lives. You're going to have very large deficits coming forward. We're in a period of great risk, and the most important thing is to know how to diversify well. We are sitting here today and we're doing the exercise of thinking, will Washington come through with a package? And then how will they finance that package? That's a big issue. And then when we deal with what will the new tax bills coming from the presidential candidates be, tax and spending, that'll be a big issue for the markets. And then when we're dealing with China's emergence and the conflicts that we're having in terms of trade, technology, geopolitics, and so on, those things, month by month, week by week, will be important for the market. First, I want to convey the mechanics of that. You run a larger deficit, and there's printing and buying of financial assets. It drives down real yields, and as a result of this, it drives money into alternative assets. There's a supply-demand problem for bonds, but when the central banks at the end of the day print, in much the same as Roosevelt did in March of 1933, that causes financial asset prices to rise and supports the economy, but diminishes the value of debt, the real value of debt. So that's the dynamic. Where we can expect it to go from here is always that way in a greater degree. So we know that if a big bill is passed, or if next year we have a larger deficit, we know that the Federal Reserve will be faced with the choice of either allowing interest rates to rise or buying that and monetizing that debt. And that diminishes the value of those bonds because it's just supply demand. When you have that debt, you have to sell it. And when we look at who are the buyers of that debt and how much do they have of it, we're dealing with a situation like in the 30s that could be threatening even to the reserve currency status. In any way, it diminishes the value of that which is being produced. That means money and credit, and it drives money into those other assets. So it's that kind of market action. People are not investors, big, large institutional investors, don't run out necessarily to alternative currency because the 3 major reserve currencies all have the same basic problem. That's why they move into a new storehold of wealth. And you see that the storehold of wealth, like in 1933 reaction, is equities, is gold, is other asset classes that go up. So when you buy a company and you have low returns on your bonds and so on, that is that kind of movement, but the same is true for gold and other asset classes. If that gets too far and it's standing the risk of, it's very dangerous. It looks like a currency defense. In other words, if those who are holding bonds, which are a lot, choose to sell the bonds because they're not providing a good return, and they're not, and because there's so much debt production and debt monetization, that puts the Federal Reserve or other central banks in the very difficult position of operating like a currency defense. Mechanistically, as money leaves that debt, that means either interest rates would rise, which would be terrible for the economy and markets, or they're forced to buy more and more. And that is how a spiral could occur. You're going to have very large deficits coming forward. There's an ideological difference. And when I look at the conflicts, I studied over the last 500 years these cycles, because the same thing, I started in the 30s and I went back before that. But if you look at that particular pattern, there is a risk of conflict that can be bad. The worst case scenario could be a situation in which we don't have a clear winner of the elections, and we don't have a clear process for getting at the winner of that election. If there's not an agreed upon process and that there's a lot of conflict about how do you resolve that type of thing, you could start to see bad things happen. If that was a situation where there's power politics and, does one state, do they use the National Guard and all of these things? How do you resolve those distances? That would be an extreme risk. It exists as a possibility. I'm not saying what the probability is, but it's a major thing. Well, I think we have to realize we're in a period of great risk, and the most important thing is to know how to diversify well, to diversify by asset class to achieve balance, to diversify by country, and to diversify by currency. Diversification well is the most important thing to achieve that balance. I think there's a bias that's a dangerous bias. And that bias is that the recent past that we've experienced is representative of the future. And if you go through history, when you have some of these conflicts, you might have a different result. And diversification doesn't cost you anything, because when your asset classes are going to, if you balance them right, have approximately equal expected risk-adjusted returns. So you can balance them because they all compete with each other. So not one is necessarily clearly better. So diversification is a wonderful, mechanical, good way to reduce risk without reducing expected return. There are 5 kinds of wars and we're in 4 of those wars, and we could be in a 5th. So there's a trade war, there's a technology war, there's a geopolitical war, there is a beginning of a capital war, and then there's the question always of a military war. And having watched these things over a period of time and having close contact with the situation, we don't internationally have a rule-based system so that there is a testing of each other's powers, which is done in public. And when leaders watch one leader win and another leader back off on that brinksmanship testing, that's a high stakes, dangerous game. It's a big issue, and it will be a big issue for the rest of our lives. I don't have a problem with my clients because we have something like $140 billion of clients who have faith in us. Otherwise, they wouldn't have us the money. We were the largest hedge fund for a particular reason. There are a lot of people who are not knowledgeable about that. We had a bad year so far. Our all-weather portfolio is up a couple of percent, but our Pure Alpha lead fund is down about 15%. We, over the last 20 years, we've never had any significant downturn, nothing, all positive years. But we knew that there will come a day. We missed the pandemic and going down, and that's the reality. I want to say that there's a problem sometimes in the media. We've had a particular problem, particularly with one correspondent with the Wall Street Journal, Rob Copeland. And if you look at the particulars on the case that we went to in terms of misrepresenting what the situation is, that's an issue. That happens. We don't settle, we fight, we're transparent, these things come about. I'm not worried about any of that. We're just operating in the same way that we've always operated, and yeah, that's right. We had, so far, a bad year.